All right, and we are live on YouTube. We'll see if we can get this working a little bit better. Had a technical glitch just a second ago. My name is Travis Hoium from Asymmetric Investing, and I want to do more of these live shows, so we'll get all this stuff figured out. But I want to bring some guests on. And today I asked Brett Schafer of Chit Chat Stocks to come on and talk about Apple. We got the Fed news today. We'll get to Nintendo and some stocks on our radar. Brett, how are you doing? And can you give us a little bit of background behind Chit Chat Stocks as well?
Yeah, glad to be here. Thanks for trying out one of these. I think you said it's the second live episode, and I definitely enjoyed doing these. Yeah, Chit Chat Stocks is a podcast that I do with another investor, Ryan Henderson. Met him in college. We started the show. We both have worked at the Motley Fool, although he works for a financial software company called FinChat now, and we've both been into investing for, I think, I don't know what the exact number is, maybe 5 to 7 years, and we do a show where we try to
Newbies, as
learn
far
a
as
lo
I'm concerned. I'm going on.
Yeah, I know,
I'm getting close to 30 years.
exactly, exactly. We try to do episodes where we learn along with the listeners, so we're gonna be researching new stocks, interviewing someone like yourself on a sector or an industry or a specific company, and just trying to get better as investors and putting that out as free in podcast format across YouTube or Spotify, Apple, wherever you get them.
Yeah, and I was on. I think it came out either late last week or early this week, and talked about electric vehicle stocks and Rivian and all that stuff. So really good content there if you are interested. Um, let's get to the topic of the day. I'm gonna share my screen here and get to some information about Apple that I think is really interesting and kind of concerning depending on your view on Apple. Now, I know a lot of people are Apple investors, whether that's through an index fund or whether you're investing in Apple directly. The iPhone 16, which they had their presentation 2 weeks ago now, I think, basically just an updated iPhone. I mean, it's more or less the iPhone 15 with a slightly better chip. Everything got slightly better, but it's supposed to have Apple Intelligence that's still not out yet. But the big news for this week was that demand doesn't seem to be particularly strong. I'm going to go through the numbers here and why I think this is important. But what was your reaction, Brett, just to, hey, maybe the iPhone isn't as hot as it was, a few years ago? And where are we in this kind of this cycle of hardware and artificial intelligence and all this stuff that's kind of mashing together right now?
Yeah, I will say for the listeners that I know there's a lot that are bullish out there on Apple. It seems like you talk to every dad out there, they own Apple stock, but I'm not going to be one to confirm biases today. I've been kind of a little hesitant on them for a while since they're trading at 30 plus times earnings and the revenue hasn't been growing in at least for 2 years now. And there is this narrative that there's going to be this AI super cycle that drives iPhone upgrades. And one thing that I looked at, I think with Ryan last week, is a chart of the declining upgrade rates in the United States for iPhones. And my reaction from the event is that, at least for me, it's not going to cause me to upgrade. I heard no one in my circle, which it's not like I'm a giant, I'm not a CNBC reporter with tons of sources or anything. It's mainly just friends and family, but no one is really talking about it. I don't really know why someone would upgrade their iPhone because of AI tools they can already get through the cloud and the internet, whether it be through Google services or OpenAI services, which there's this pitch from Apple that it's Apple Intelligence, but a lot of it is a partnership with ChatGPT
Well,
and
yeah, some of it. I
some
mean,
of it, right?
we can get it. I mean, so yeah, what Apple's trying to do is more localized stuff, like stuff for
Right.
your email or your pictures. Like I have little kids, so it is like a daily occurrence where it's like, do you have that video of our daughter, doing something in this place 4 years ago? And it's like, yeah, I can spend the next 10 minutes searching through my phone and try to find it. There are features like that that I think you can just say like, um, you know, find the picture of the kids in the pool on around this date, and like that would be pretty cool. But you're right,
That would be great.
it is kind of like we don't know exactly what we're using this stuff for, and I think that's kind of what you know, that's what I think you and I are both in the same page of like we're having a hard time put our finger on exactly what this artificial intelligence thing is. I want to put this in context of um, Apple's sales because I think this is where I think you and I sort of agree on that price to earnings multiple that you brought up. This is iPhone revenue. And I've just got a chart here from FinChat that shows iPhone revenue goes back to 2012, fiscal 2012. And what you can notice here is iPhone revenue peaked in the 2022 fiscal year that ends at the end of September 2022 and has been in decline ever since. The last number isn't a full year, but it's a trailing 12-month number. So that's in decline. That's a little bit concerning. And one of the things that analysts are thinking right now is that this is going to lead to the Apple Intelligence is going to lead to some sort of upgrade cycle. Do you think that has any merit, Brett?
I don't think so.
Okay.
And
Th-
for
th- I,
example, like you look at
that, I think
what
that's what's so interesting is like this is the maybe the most important product in the world. It's they're coming out with a new technology and it's kind of like, maybe this isn't that big a deal.
yeah, and it's shot up the stock from say 25 times earnings to 35 times earnings, and that's what from an
Yeah.
investing perspective gets me nervous about it when it's a low growth company at a what would that be, a 3.3 to 3.5% earnings yield. That doesn't excite me too much. And what also concerns me is the fact that not all of these products are ready at launch. So that
Right.
makes me think that, at least for the time being, they are behind the Googles and the OpenAIs of the world, because it seems like these are all products that Google has already come out with. Yes, they don't have that iPhone distribution. And you mentioned that
Mm-hmm.
localized person, relationship and the personalization they can make with their iPhone users. But if Google's already got all these products out there, uh, if anyone has any sort of edge to gain market share, and I know Google Pixel has no market share, it would be Google. And it's not going to be a huge deal if they go from 3% to 5% market share, but that's, you know,
Yeah,
it's
the
better
case
than
for
going in the
Google would
opposite
be
direction.
they have the ability to basically vertically integrate hardware, software, cloud, on device. I mean, they're making their own chips for the Pixel device now. That they have TPUs in that device. So yes, Apple's also making their own chips, but Apple doesn't have AI models. They don't have all of the data to build these models that Google has. So I think yeah, it does kind of change the competitive dynamics. I want to add a couple things and then get your thoughts, Brett. Um, this is a look at the hardware sales for Apple. So this is not just iPhone. This is iPads, Macs, and then AirPods and all the other hardware. So HomePods is included in that. All that stuff. And same trend holds true. It actually exaggerates what we talked about earlier that sales are declining over the last couple of years. So what's going right at Apple? And we've kind of alluded to this. Oh, I've also got the gross profit. So same trend, but I added the gross profit column. You can see the gross profit is falling from a hardware perspective. So what's going right? What's going right is the services business, and the services business is um, the 30% tax that Apple takes on every digital sale that you have on their devices. So there are these really restrictive rules on App Store sales, and if you're selling something, if you're like Spotify or there's a reason that Spotify and Netflix, don't allow you to buy stuff on device in most cases, because Apple takes 30%. Just like if you do a subscription, like if you sign up for Max or Disney Plus on an Apple device, Apple gets 30% of that. Still a little bit crazy to me. Um, but that's a piece of this picture, and then also that Google revenue. So we've heard a lot about the around $20 billion check that Google writes to Apple every single year to be the default search engine on iOS devices, and I think even that extends to Macs. And that's where I do want to tie in that services revenue story with Apple Intelligence. And I've done some videos on this, but one of the things I don't think we're talking about, you could argue that maybe we're going to have some sort of upgrade cycle as people try to buy devices that have more AI tools built into them. I think there's a lot of analysts that think that, and that, like you said, the stock is up. But what about this services revenue? If you're using Google less on your device, that means
Good
less
point.
revenue and less profit for Apple. And now that revenue source becomes a cost center because it's costing Apple more to make devices that have the chips and the RAM that are capable to doing all of this AI stuff. And they did not increase their prices on the recent iPhones. And they're building out these tools in the cloud, which are very expensive to do inference. So we're potentially taking the best revenue and profit growth story that Apple has and turning it into a cost center. That's something that I don't hear a lot of people talking about, but I feel like it needs to be part of the story.
Yeah, I haven't thought about that either. At least the fact that if you're giving up Google search revenue or the thesis around Google losing share, which if it loses share, it's going to lose share on iPhones probably proportionally or even more because there's more first tech adopters among iPhone users.
Yeah, much higher spending too.
Yeah, and ugh, I mean, the services revenue has, at least as you mentioned today, from that 30% take rate, which I think the rumors are they have over 50% profit margins on the App Store, which I think makes sense just because it's
Yeah.
such a how much what are the maintenance costs there? Not too high. And then
Well, and they got so much
Google
leverage
search.
on that. So yeah,
Yeah,
absolutely.
exactly. And then Google search, well, that's probably even higher. I know that there's probably some cost there, but I think that might be
The
95% margin.
there's like a guy in a in a dark office somewhere managing that. That's your cost, is paying
Yeah.
somebody $100,000 to just collect the check and make sure it gets to the bank account.
Yeah, and you could see service revenue continue to grow, but I would agree with that. Like that could happen. They're doing this healthcare stuff. I mean, think about the one cool innovation, at least I saw, was that hearing aid disruption from the new AirPods. It looks like some stuff like that would be very, very valuable for people, and the services could continue to grow. But calling for faster upgrades or a stabilization of that upgrade cycle, which has gone for 10 years now, I think even longer. I think the chart I saw was from 2010. It's an oscillation because there's more upgrades I think during the holiday season, but it's gone down and down and down at a pretty linear rate except for COVID. And as we
Hmm.
saw, we had that COVID bump that helped with revenue. But yeah, I could see the services story continue to play out. But even if services grow at 10% a year, and as you mentioned, the margins probably aren't going to get better, and in fact, there's a chance they get worse, that's not gonna move the needle for a stock trading at 33 times earnings when this is not their entire business.
So let's get to those numbers. This is just the Apple numbers overall. So we've talked a lot about the segments so far. This is the Apple numbers overall, and you can see again the revenue is essentially flat from 20 since 2021. You did have that COVID bump. Profits essentially flat over the past few years as well. This is what we've been kind of dancing around. This is the multiples, and this is where if you have a company that you was a growth company, and the purple line that I included here was their year over year growth rate, and that's really volatile over time. They have these like massive swings of growth. That's why I think investors are so interested in their upgrade cycle, because if there is one of these 2015 or 2021 upgrade cycles, that can be a massive boost to both revenue and the bottom line. But if we're not seeing that, then does the company deserve to trade for a multiple that is higher than we have ever seen, at least in the past 10 or 15 years since the iPhone came out? I mean, Apple stock was actually pretty cheap in 2014, 2015. Remember, that was when Buffett was buying shares. He's now selling shares like crazy. And I think this is the biggest reason why is you have a very expensive stock trading for over 30 times earnings, almost 9 times sales, which is a crazy number for a hardware company. Yes, they have a lot of services revenue and stuff like that, but Apple's getting a lot of credit for future growth that I don't know if that future growth exists. And I think that's just fundamentally that's what makes, if we go back to the first page that I showed, if iPhone 16 sales aren't going to goose their revenue, this is really a stock that should trade more like 15 times earnings.
I agree. Yeah. Now, I think both you and I would also not argue with the fact that Apple is a wide moat business, but it is low growth. And I remember on Chit Chat Stocks, we covered Peter Lynch and tried to do a kind of did a full episode of what his philosophy is and what we can learn from him. And one of the key lessons I took away from, and it's not something I wasn't aware of before, but it helped internalize it more, is a high multiple stock with as one of the largest market caps in the world is very dangerous. Like you have to be confident in that growth rate because trading at 30, 35 times earnings as someone that's already doing $300 billion plus in revenue, it's tough. And yes, people can make the same argument about Amazon and Google or Alphabet, but they still have, at least from my
They're still
perspective,
growing.
better, longer runway for growth,
Yeah.
where Apple has not shown the consistent growth lately. And it's just a very, from his perspective, what he said was, look, you're buying in a high multiple and you're betting that growth is going to continue. And if it's only gonna grow at inflation or GDP or whatever, it's just not gonna work for you. And even if it does, some of that upside's already priced in,
Right.
and the returns aren't gonna be that sexy. It's not gonna be a 10 bagger. So the juice is not worth the squeeze if you're
Yeah,
going
and
for a
we're
home
talking
run or
about
something like
Apple.
that.
We're talking about a pretty established company. We're not talking about one of the biggest companies in the world that is trading for an even more insane multiple, and that would be Nvidia. So that is kind of like a big question about the market overall and where the market is at. I want to
Yeah.
use that as a chance to pivot to, we're about 90 minutes away from the Fed announcing rate cuts. I mean, are we going to have a 25 basis point or 50 basis point? The amount of time we spend talking about 0.25% on short-term interest rates. And if you're not familiar with what everybody's talking about, what the Federal Reserve does, they do not control long-term interest rates. So they do not determine like what your mortgage rate is going to be next month. They control the short-term interest rates. So basically 0 to 3-month interest rates, and then traders, investors kind of back out, well, what are rates going to be like in the future? And a normal curve is that rates are 1 point today, and then we're expecting them to be a little bit higher in the future because you're getting price for risk and all that kind of stuff. When things invert, meaning that future rates are lower than the current rate, that's when you're in kind of a weird environment. We've been in that for a little while now. But they're expecting to cut rates today, 25 basis points or 50 basis points. The idea behind that is that inflation has kind of been licked, and that was the reason that rates were increased in the first place. And now you're starting to have an increase in unemployment. I wrote on Sunday about how we're going to this part-time economy where actually if you look at full-time jobs versus part-time jobs, the number of full-time jobs is actually declining pretty regularly and the number of part-time jobs is increasing. So that unemployment rate is kind of masking that the employment situation overall maybe isn't quite as good as it looks if you just look at the unemployment rate. But with all of that said, does this matter, or what should we think about it? Because there's going to be billions and billions of dollars traded based on whether it's a 25 basis point move or 50 basis point move. Do you care, Brett Schafer?
I care specifically for any banks I follow that could
Okay.
be affected by it positively or negatively. I take it on a case by case basis. Maybe if you're in home builders, it could be, or anything housing related, that could make sense just given the unaffordability issues with the frozen home market. So that could be something I care about, but does it affect Nvidia? Should it affect the mega cap stocks? I don't think so. And what's interesting is, they're already below the risk-free rate if you look at their actual earnings yields
Yeah, and earnings
at the
yields,
moment.
you're taking the earnings that they have divided by their market cap.
Right, inverting the PE, yeah,
Yep.
and that's supposedly supposed to be how you set your stocks versus, the long-term treasuries and stuff like that, and they're already below that, and they're typically supposed to be higher, quote unquote, according to the theories. But and I know growth is a part to play in that. But besides the point, no, I don't think it matters for some of these large cap ones. And when people talk about the cost of capital too, which is again, referring to if the Fed's lowering interest rates, your cost of capital is lower. But none of these companies, as we stand here today, maybe if you talk about Magnificent Seven, Tesla might be capital constrained in a couple of quarters if things keep going
They
in
would
the
be
wrong direction.
impacted
But
on more, I think, the buy side. Is it easier to buy a car or harder to buy a car?
Yeah, they could definitely be impacted, but the other ones, they don't they don't
Won't be.
have a cost of capital. They're
They're
honestly
actually going to
gonna
make less profit because of all the
yeah.
cash that's sitting on their balance sheet is going to be making less interest.
Yeah, so you can really spin yourself in so many different directions because you can say, well, okay, it's easier for people to get a car loan, credit card loans, blah 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 blah. But you have all these people have their savings that were in high yield savings accounts that were earning nothing that today are earning 4.5 to 5%. Well, I think it's more 4 to 4.5%. Well, if that goes away, that's less income that people are earning.
Hmm.
It I don't know what's gonna happen there, but I will say I don't think a drop of this magnitude, whether it's 25 basis points or 50 basis points, is going to unfreeze the housing market when the aff the affordability is still gonna be at a record high compared to anything besides the last 2 years. If mortgage
Right.
rates are in the 5 to 6% range versus the 6 to 8% range, housing prices would just have to come down or the economy has to grow.
Yeah, I always try to put context into what do actual businesses and actual people do based on some of these things that we worry about and like tie ourselves in a knot over in financial media. If the Fed lowers by 25 basis points or 50 basis points, like, are you going to buy a house? Like, that's probably not going to impact you on an individual basis. Now, if we go down to 0% rates again, maybe that changes the picture. But if we go down to 0% rates again, something went
That's not
very,
good.
very wrong. So,
Yeah.
Anthony Noto, SoFi CEO, I thought was really clear headed about this when a lot of people weren't earlier this year. He was saying, look, the one of the reasons the market went up so much early in 2024 was the investors were expecting 6 rate cuts, and he said if the Fed cuts rates 6 times in 2024, that means the economy is doing horribly. Like, we don't want to position ourselves to have more exposure, take more risk, and then have a really crappy economy. So I think they were really smart with that, but his logic was just so simple, and I think that's really the way to think about it. Is the reason the Fed is lowering interest rates is because the economy is not growing at a very high rate, unemployment is increasing. So they're saying, how do we goose things from here? How do we put some stimulus in the system? We only have a few levers. One of them is lowering interest rates, so we're gonna do that, especially now that um, inflation is not the concern that it was a few months ago. But I don't necessarily think that's bullish, right? We're already at, if you look at the PE of the S&P 500 overall, we're already at a record high price to earnings multiple, and now you're saying that the economy is getting a little bit worse. I just don't think that's. I I still want to just go back to individual stocks and say, is this stock a good value for the growth trajectory and the strategy that they are executing? Not, oh my gosh, I got to buy stocks because the Fed's going to cut rates by 50 basis points today.
Yeah, one saying we have is that if you are worried about your portfolio or you're worried about this stock when interest rates go from 5% to 6% or 5% to 4%, well, I think you have the wrong stock. Because
Yeah.
a good company is one that is robust and resilient throughout, you know, any sort of business cycle or Federal Reserve hiking cycle or what do they call it, shrinking, lowering cycle. They need to be able to weather things that are outside of their control because no company, I don't think anyone's bribing them. I would hope not. Is controlling what the interest rates are. That's out of their control, and you can't. As an investor, you can't control it either.
And I'll end on this because I see this in comments a lot here on YouTube. Um, if part of your investment thesis is, well, when they cut rates, and this is kind of what you were just saying, that's a really bad thesis because, like we talked about, there's a reason that they're cutting rates. So our solar company is going to be able to make a little bit more margin if they cut rates, sure, but there's going to be fewer people who are going to want to put solar on the roofs because, or be willing to pay the price that they would have previously because the economy is a little crappier than it was. It never, this is one of those things that often works out the opposite way of what you think. And there's some historical numbers like during the pandemic that's just, don't take that as reality. If you learn something, like, forget everything that you think you learned between February 2020 and like June 2022, because that was not really reality. Rates don't go to zero, and people don't just stop buying like stuff, stop driving and put that money into SaaS companies. That's not normal.
Yeah.
So I just want to caution that. You wanted to bring up, let's cover this quickly before we go to Stocks on our radar and get everybody out of here. You wanted to bring up news from Nintendo. What do they got going on?
Yeah, I think it's a fascinating company. It's also a fun one since I think almost every listener is aware of them. And I also think it's a interesting company to follow because the stock looks cheap in a if the new thesis is right that they're not a cyclical company anymore. So there's been rumors, and there's been rumors for a long time, but there's rumors that seem a lot more substantial that Nintendo of America invited a bunch of developers over to their campus, which I got to say is actually a 45-minute drive from my house. So I could have done some boots on the ground reporting, but I'm not that, doing that deep of a
You're not
dive
that
into the
crazy.
stocks I own. But there was photos taken from the developers that showed up online, so they were there, and the reason they were there is to, in all likelihood, test the new console that is announced. The name hasn't been announced, but Nintendo said it's coming out within this fiscal year, or is currently planned to come out within this fiscal year. I would maybe, given their prevalence to not caring about timelines, say it's coming out soon. And then there's
Mm-hmm.
also rumors that they've started building it at a factory in China. So it seems like the next 12 months makes sense for one of these things. You've also seen it with their game slate. You kind of got to read the tea leaves with them because they don't give you any long term stuff with their IR team besides the fact that they want to deliver smiles to their customers. It's not too concrete for the investors. But suffice to say, if we look at their earnings today, they're earning about $3 billion. Now that's down in USD terms from the peak during the pandemic, and some of that's because of the yen. But again, they did hit a cyclical peak during the pandemic because video game spending went up, and that was at one of the core points or the mid cycle of the Switch, which launched in 2017. So there was a bunch in hands. There's a lot of software coming out. They're making a ton of money, and I think a lot of
I'll pull
people
up some
have.
of this while you're talking.
Yeah, yeah. I think there should be some stuff on FinChat. But if you look at the charts of the last few years, earnings have come down. Now they can't control the yen, but that would be concerning if you just looked at it in a vacuum. But if I look back to pre-switch, and that's when they were about to launch a
Did that
new
come out in
cycle.
2018? Fiscal 2018?
I think fiscal 2017 would be the one that's right
So we
before
go
the
from
switch. But either way,
$4.4 billion in revenue USD to
yeah,
9.9 in fiscal 2018. So it would have been,
exactly.
yeah,
So
calendar
that's the
2017.
same
Okay.
year of, say, right before a new console is going to be released. You got a lot of people waiting for this new console to come out. You got a lot of people waiting on game sales. You got them themselves putting a lot of development into these new games that are going to be on the new console but aren't coming out this year. It's kind of a weak game slate. And the thesis is, given that their enterprise value is kind of in the 40 to $50 billion range, depending on how you value all their securities and their assets, and where the stock is trading, which can kind of trade widely in US dollar terms, just given how wild the yen has been. Well, if they are at $3 billion today and can juice that up to $4, $5, $6 billion when this new console comes out, I think it's an interesting time to be following Nintendo. Full disclosure, I do own shares, not a giant position, but it's one that I think has a wide moat given their entertainment assets, and they take care of their IP in a much better way than American companies. And yeah, I think, if this is the down cycle, there's a lot to like. Uh,
Yeah, I'm just
any
pulling up
questions
some of
on that?
this info. Stock price, it's kind of hovered flat over the past 4 years or so.
Hmm.
I
A
pulled
lot of
up the
that's yen.
price to earnings multiple says 5. Is that correct?
Yeah, sometimes that the aggregators, given it's a Japanese company, is tough. I have given
Yeah,
their
that doesn't
operating
seem quite
earnings are
right.
about $3 billion, and their enterprise value is about 40 to 50. They're kind of in the low teens right
Okay,
now. But
that sounds more accurate.
yeah, but the thesis is that they're at the bottom of the console cycle, or near the bottom. I mean, the next few quarters will probably be the true bottom, but or the one right before the new console releases. But you look at, say, Mario Kart sold about 60 million copies, and those are high margin copies when they get sold. Actually, the one that gets sold each year, and they sell like 5 million units now. It's sort of like Grand Theft Auto 5. This one was released actually on the Wii U originally. So this is the mainstay game. This is one of maybe the Mount Rushmore games of video games, where it's just such a dominant franchise. And when that comes out, the next one, I mean, that alone can help drive earnings higher. But yeah, I think it's a great company. And there's a lot more to the thesis. You have the widening of the entertainment sphere with the theme parks and the movies and stuff that bring people, in relation to the console where they make a lot of the money with the games they sell. But I think the thesis as a whole is, and what gets me excited is I think they are some of the best entertainment assets in the world, and they manage it well, and the stock looks cheap if, again, they execute on this new console. So we're going to get the answer to that question shortly.
The other just little note is PlayStation announced their, do they call it Pro model? It's kind of like their upgraded PlayStation 5, and they increased the price on that. So it certainly seems like the console business is getting to the point where they're not in growth mode, they're in cash extraction mode. Um, Switch is a little different because it's not the same. It's not a hardcore gamer market. It's more my kids, which, I mean, there's really no better product for kids than something like the Switch. So I just wanted to note that I don't be surprised if they are able to increase prices, that's something that I mean, video game systems today are the same as I remember just sitting in line for the PlayStation 2 when that came out. I think that was in 2000, and they're kind of the same price. I think that was $300 then. They're a little bit more now, but not a lot of price increases over the past 20 years, and possible that they'll be able to push on that lever as well. I want to
Yeah.
ask, end with stocks on a radar. We can just do this quickly. What are you looking at that has sort of piqued your interest?
So the digital remittance disruptors definitely interest me.
What
I've
does
just
that
added
mean?
uh, so remittance is like sending cross-border payments.
Okay.
So if you were in Belgium, I'm in the United States, you need a way to send the money, and a bank doesn't really connect, and you have the local regulations. So I'm interested in the ones that are using, say, mobile phones, modern technology, better ways to do things to cut costs and help save all these people time and money, since everyone has a smartphone nowadays. And I've owned Remitly. Uh, well, I just bought it this month. I think it's growing quickly. It's doing well. But one that's intriguing me, that's also a digital remittance disruptor, is Wise. Stock's gone down about 30%. There's concerns about them cutting their costs and cutting their fees, which are going to lead to some short-term headwinds. But these are self-inflicted headwinds that they want to do because they want to have the lowest cost possible. There's also some concerns about the net interest income they've been earning on the cash from their balance sheet, as you mentioned earlier, with the Fed, interest rate cuts. That doesn't help everyone. For someone like them, they're actually going to get hurt by this. But I think it's an opportunity potentially, and I just love the management team. They seem to be focused on the right things. They're talking about how they want to have a cost plus model similar to a Costco, where they want to lower their cost for remittances on from smartphone to smartphone around the world as much as possible. They're signing up banks such as Nubank, Monzo, some banks in Indonesia to use Wise as their cross-border payments provider, which I think is also a great thing to help eliminate any competition and kind of make the potential enemies your friend. And the stock doesn't look too expensive. If you think that they execute on this, there's a long runway to grow. And I think the digital remittance market, it's a classic innovator's dilemma. The old players, Western Union, the banks, are wildly expensive. They have legacy tech. They don't want to give up these profits. And they have that tech debt that Wise and Remitly and potentially others could take advantage of.
I'm going to give you another name in sort of the same space, different technology, but Coinbase. Um, just I've seen the data on the efficiency transferring things like USDC into, the other different stable coins, and it's just much more efficient. So, but anyways, two names to kind of think about in that space. The one that I am looking at, I did a analysis on Motley Fool Live about this recently, but I don't know quite what to think right now. Is Figs. Um, Very, very good balance sheet. They have a really strong niche. If you're familiar at all with everything I write or do on YouTube with asymmetric investing, I love the smiling curve concept, where you have an aggregator on one side. They have tons of scale. There's nobody that can beat Amazon, for example, in retail. The way that you would compete with them is you would say, I'm going to take a little teeny piece of this business and I'm going to focus on that and I'm going to do it better than anybody else. And so if you need scrubs, you are going to come to me. That's where they sit in the market, is on kind of the left side of the smiling curve. Phenomenal growth up until about 18 months ago. And what their management has said is that, well, you went from this time during the pandemic where even people who were working in hospitals were like buying 10 pairs of scrubs a year. And then they went to buying like 2 pairs. Normal would be more like 4 or 5. So do we have just sort of a over purchasing of inventory, if you will, by customers, that led to sales flattening out and going from a really, really impressive growth curve to a flat curve? Stock's down, I think, almost 90% from its peak.
Wow.
But like I said, really, really good balance sheet. I think there's about $200 million in cash on the balance sheet. The market cap's like $900 million. It's profitable. I just don't know if they're going to get back to growth. So that's what I'm trying to think through and kind of suss out exactly what's going on in that market, because it's very possible that they become this dominant player in that scrubs business. They've only got about 5% market share in the US, but they could potentially grow that to 25, 30, 40%. And who comes after them if they start to dominate that market? You just got so much more scale. Their products are relatively inexpensive but high quality, very, very high margin. Anyways, a lot to like. It's just a matter of, do they get back to growth or not? And I don't have the answer quite yet.
Yeah, I think that the brand is still good. The people I know that are in the industry or that work, would buy scrubs seem to love Figs. Their
Yep.
pitch of being, not baggy and ugly looking seems to make sense. And yeah, well, I guess it does also make sense that, Lululemon and Nike aren't going to be coming after them. It's too small.
Right.
They're going to stick
Right.
within their niche. Yeah, that limits the size they can get to, but
Right.
I would
This
be
isn't going to be a
curious. I
$100
think
billion company.
maybe, yeah, like I would be curious what management's commentary is about growth ambitions, because if they talked, I don't know, I would be a little concerned if they talked a big game about expanding the brand and stuff like that. That might be a bit
So
concerning.
they
If
have,
they stick in their niche, they can be strong.
yeah, the plans would be more kind of in hospital. So they've moved from scrubs to what they call, I think, under scrubs, which is like kind of this stuff you wear under your, like a compression gear almost. Um, and then there's kind of like ancillary things. I could see, like, instead of this crappy thing that you wear as a patient, maybe there's something
Mm.
a little bit
Hmm.
nicer that ends up coming from Figs. They can get into what they call teams, which is like outfitting an entire hospital so everybody looks the same, instead of one nurse wearing pink scrubs and the next one has flowers on, and the doctor's got a gray scrubs, and you're like, who the heck is everybody around here? Anyways, intriguing. It's on my radar. I have not covered it on anywhere on asymmetric investing, so this is the first you're hearing about it here. But expect me to at least touch on that in the future. So,
Yeah, I think that could be a
Brett,
fun one. I mean, I forgot about the entire company
yeah,
for 2 years
I
now.
know it's
So
these IPOs and SPACs that I want to go back to all of them. Like, what sort of good company was there that just got destroyed because of SPAC hangover and all this other stuff? There's some good ones out there. I've covered a couple of them on asymmetric investing, but this might be another one. We'll see. Brett, thanks for joining me. If you don't follow Chit Chat Stocks, I put a link to that in the show notes as well. Their podcast. I have the Spotify link. I can add the Apple link as well. And of course, sign up for asymmetric investing here on YouTube. And then I've got the link to the newsletter on the bottom there. So much more detail there. Thanks for joining me. We'll have to do this again sometime, especially if there's one of these big mega cap companies we can kind of dump on a little bit for getting a little bit out over their skis.
Yeah, exactly, exactly. All right, yeah, thanks for joining. Thank you for all the viewers and listeners for tuning in. And yeah, check out Chit Chat Stocks. We'll have great guests like Travis on a regular basis.
Absolutely. All right. Thanks. Have a good one, everybody.